Hey guys, welcome back to the channel. This is Hamza with Trading Secrets. Today we're going to talk about a strategy which is going to help you save a lot of money. It's going to help you save a lot of money when you're investing. It's called dollar cost averaging, right? I know it's a very simple concept. I'm pretty sure most of you guys already know about it, but knowing about a strategy, knowing about something, and deploying it correctly are two completely different things, right? You can know about something, but then if you don't have a strategy, if you don't know how to apply it in a real-time situation, right? When you're down or the stock is moving very fast, it can be asking for trouble, right? You can dollar cost average in the wrong way. So let's just cut to the chase. So for example, you have a stock which is $10, right? And you want to invest $3,000 into the stock. That means you can buy 300 shares off that stock, right? So now you don't just want to go there and use your $3,000 and just buy 300 shares right away. Because guess what, guys? If that stock falls to $5 tomorrow, or next month, or a couple of months later, now your $3,000 is going to be $1,500. It's going to be cut in half, right? So this is where you gotta strategize, right? So some people, people like to play differently. Some people are just going to buy half and then buy half later. Some people are going to do 1/3. But I think a good strategy is that you just go in 1/3. So if you have $3,000 and you want to buy 300 shares, you just buy $1,000 worth of shares, which is going to get you like 100 shares. So now, let's say the stock starts falling down. You wake up and you see, oh, the stock is down 10%, and you're like, oh, what the hell, the stock is down, I'm down. You see the portfolio, you're like, oh man, I'm already down 10%, I just bought this stock. So you think, all right, you know what, I'm gonna average down. Now that can be a mistake, averaging down too early, because obviously, okay, so you see the stock has gone down 10%, you say, all right man, I'm gonna buy another $900 worth, and I'm gonna get another 100 shares, right? So you average down. Guess what? The next day, it goes to $8, and you say, you know what? I'm just gonna average down more, and then you just go all in. Now, if the stock falls more, I don't think you have much you can do, right? There's not much you can do. So that's a wrong strategy, right? And then if you just go all in too early, you're gonna end up getting burned at the end, right? I've been there, I've done that, and I know that's going to happen. I know these stocks can be volatile, especially the growth stocks that a lot of us, a lot of you guys like to invest in. So this is what you guys can try, and I think this might be like a very good strategy, which might work. It might work for me, right? I've tried many different strategies. This one works for me. So you just buy like 100 shares at $10, and then if the stock is going down, let it come down. If the stock is going up, it's fine. So if the stock goes up 50%, now it's a win-win situation, guys. Your $1,000 is already $1,500, right? So you're already up 50%, and you already have the $2,000 that you saved for the stock. So yeah, you can average up if you want, if you have like a really high conviction in the stock. A lot of people, what they do is they just buy a specific stock, right? They will say, okay, I want to buy Nvidia, so they'll just buy some Nvidia shares every month, or every other week, or every week, or whenever they have some, they have some spare cash. That's a good strategy, right? But if you buy something, I think a better strategy is that you buy something. You have an allocated fund for a stock. You buy it. You have like as I said, you have $3,000. You're buying 300 shares of a stock that is $10, right? So when it comes down, that's when the real test begins, because that's when you're gonna wake up. You're gonna look at your account. You're gonna be like, what the hell? I just bought the stock and it's down 10%, 20%. Guys, that's okay. It's fine. The market's going to move. The market's going to go up. The market's going to go down. These stocks are volatile. They're going to move as long as you have done your research on the company. This company is good. The financials are good. The foundations are good. You're good. Yeah, of course. I mean, if the company is falling 20% because, there's something fundamentally that has changed about the company, right? Or they're about to go get bankrupt or something, or there's something really bad happening, then yeah, maybe you should cut your losses, right? Don't just don't just catch a falling knife. But if it's just moving with the market, guys, it's very important. The stocks are gonna move with the market. It's if there's a stock that's trading on Nasdaq goes down, the stock is gonna go down most probably, right? So if the Nasdaq is going down, it's very normal for a stock to go down with it, right? If you're on a sinking ship, you're gonna sink with it, right? But it's gonna recover. It always recovers, right? Historically speaking, the market always recovers, right? It does its thing, and then it just recovers. Sometimes it's gonna take longer, but that's where the dollar cost averaging comes in, right? So let's say you bought the stock at $10, 100 shares. Now it comes down. It's at $5. Now at $5, you can double down. Now if you have conviction in the company, you're down 50%, right? Now, if you went all in at $10 and the stock is at $5, who knows how long it's going to take for the stock to go back up to $10, right? But if you have your money, the $2,000 that you were gonna invest in the stock, now you have that dry powder, you can double down. You can buy. So at 1,000, you were buying 100 shares for for 1,000 at $10. But now at $5, you can buy 200 shares. Or even better, you can buy 400, So now, let's say you just buy 200. You say, all right, man, I'm gonna invest another 1,000. Now you're gonna get another 200 shares. So now your average cost base is around $6.66, right? And the stock is at $5, guys. So just imagine going from 5 to 10. That's your break even. Now your break even is $6.66. So the stock, as soon as the stock recovers 35%, you're already in the green because you average down smartly, guys. You get what I'm trying to say, right? If you average down smartly, you are more than likely you're gonna come out on top. You're gonna be in the green before you know it. As long as it's a good company, the market's gonna recover. It's gonna recover with it, and you have already averaged down. And then the best part about averaging down is that now you have a stock and you have more shares, guys. So if it keeps running up. If the stock runs up to like $12 from here and it breaks the $10 mark that it was originally at when you bought it, guys, that's a double up. That's almost a double up for you. $13.30. You're already at a double up, right? So that's how you can just minimize the risk, and you can make a lot more when you're averaging down smartly, right? Instead of just going all in, just foaming, all right, man, I'm just gonna go all in, and then at once or at the first drop. So you gotta average down smartly, guys. Hey, listen, guys, if you like the video, make sure to subscribe and like our channel and share the video. And if there's any other topic or any other stock or any other crypto or any topic that you want me to cover, type down, just comment below, and I'll try my best to cover it. Thank you, and see you next time.